Hello and welcome back. I'm Natalie MacDonald and you're watching Sydney Direct on Dukascopy TV. A central bank contagion continues. I've travelled down to Melbourne today to talk strategy, sentiment and trader yields with Head of Investment and founder of Asenna Wealth, Assad Tannous. Assad, thank you so much for letting us come into your office today. It's a great pleasure to speak to you.
Thanks for having me. It's a pleasure.
No worries at all. Okay, so today we're talking central banks, and the RBA became the 15th central bank globally to ease policy, to cut rates, to make those moves. How does this impact trader strategy and also trader sentiment, particularly if we consider really shock moves like the SMBs, for example?
Okay, we need to go back to the November minutes where the RBA clearly stated that they had a neutral bias and that they were concerned about the froth in the residential property market, in the Australian residential property market. So we fast forward 2 months and then all of a sudden the RBA cuts by 0.25%. I'm of the firm belief that that was purely a political decision. Their main objective was to drive down the Australian dollar and as a direct result of that, increase earnings on, increase the price of the value of Australian commodities priced in Australian dollars, and then as a direct result of that, fix the revenue problem that the Australian government has through taxation in their budget. Now, you ask how this affects sentiment. Well, clearly, you don't need to look any further than the ASX 200. We had a 200-point move leading up into the announcement, the interest rate announcement. What tends to happen is when the market discounts moves such as this, it usually sells off on the news, but in this case we rallied another 100 to 120 points on the actual interest rate cut, and I think that's because historically the RBA has a tendency to cut rates in 2s and 3s. So to answer your question, it improves sentiment dramatically.
The Bank of Canada has come under scrutiny for supposedly verbally intervening with the loonie dollar and driving that down. Something also that we've seen obviously for a long time with the Aussie dollar and the RBA. With policy makers seeking to push down currency, how does this impact on yields?
Okay. To answer this question, I'm going to use an example. We're going to look at Telstra Corporation and Commonwealth Bank. Historically, they're trading on high multiples. Commonwealth Bank's at 16 times earnings and Telstra's at 19 times earnings. Now, the reason for these high valuations is because the cash rate's trading at historical lows. If the cash rate was trading at the historical average of 4 or 5%, then you can argue that these companies are overvalued. But the historically low cash rate and historically high valuations are inversely proportional to each other. So assuming these companies don't increase their dividends, as the value of these companies increase, their yield will fall.
Okay, now, but obviously at the centre of all of this and the big driver really is US Fed policy and where traders and where markets see that going. How does that sort of tie in really?
Okay, to answer this question, we need to go back to the last quarter of 2014. We had upward revision on non-farm payrolls and they were revised up to about 1 million jobs created for the quarter. Now, we haven't seen that kind of job creation since 1997. So you only need to look at like one of the major pairs, and in this case we'll use the example of the US dollar yen, to see what kind of impact those revisions had on the stock markets. On the actual non-farm data, the yen rallied, or the US dollar yen pair rallied 200 pips on the news, moved into a bullish wedge formation, and then broke a major resistance point of 119.20 to the upside. Now, we believe that this is the start of the next major leg up, which should drive it to around 125. Now, clearly the market is the strong US dollar is clearly discounting an interest rate hike in the US in the short term.
How then does all of this speculation actually tie in then to global markets, and what sort of consequence can we see? If we look, for example, at the taper tantrum of 2013, that really caused a lot of damage to emerging markets. What's our 2015 equivalent almost?
Okay. I'm in the business of not making predictions. I prefer to let the market act and react. Like it's the fact that you're trying to predict the black swan event is an oxymoron in itself. Like you're trying to predict something that nobody knows that will happen. So a wise trader of the name of Jesse Livermore once said, never try and predict the bottom 15% or the top 15% of a trend. When markets top out, they don't just crash. They move into sideways distribution patterns. And then from these distributions, they tend to break down. And it's uncanny how many times these downside breaks are followed by so-called black swan events.
Assad, thank you so much for your comments today. Really appreciate hearing from you.
Thank you. Thanks for having us.
Not in the business of predicting black swan events. That was Asenna Wealth's Assad Tannous. That's all we've got time for right now. I will be back, but goodbye.